Hello and welcome to episode 14 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
This week, instead of diving into tariffs once again, we will briefly discuss the mixed signals the Trump administration is sending to US steel investors related to the acquisition by Nippon Steel. We will also discuss a unique contingent value right, or CVR, associated with GenDigital's acquisition of MoneyLion, which is expected to close in the next few days. We will briefly touch upon the big spike in insider buying and purchases of GameStop by three different insiders, including CEO Ryan Cohen, as well as continued insider purchases of the TV broadcasting company Sinclair by its executive chairman David Smith. As always, we will see if we can weave in Elliott management into this episode and discuss management transitions at Harley-Davidson and CVS.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
Let's get started with this podcast with a look at rumored deals, or as we like to call them, deals in the works. Capgemini, the French IT company, is in advanced talks to acquire the business process management company WNS Holdings. WNS Holdings has an enterprise value of a little over $3 billion, while Capgemini is almost 8 to 9 times bigger with a market cap of $24 billion. Capgemini seems to be a very large company that operates in 50 countries and has 340,000 people working for it.
Right. Another interesting deal that we saw had like a deals in the works or rumored deal situation came from the clinical stage biopharmaceutical company Keros Therapeutics. The company launched a strategic review that includes a potential sale of the company, but strangely enough, also adopted a poison pill provision to deter hostile takeovers.
In case you're wondering why they are both exploring a sale and at the same time using a poison pill, the company has a market cap of $500 million after a nearly 80% decline in the stock over the last year. Keros Therapeutics stock was hit hard last December when the company said that it was stopping phase 2 trials for its drug focused on pulmonary arterial hypertension because of safety concerns.
The company has nearly $560 million of cash on the balance sheet and no debt, giving the company a negative enterprise value. This is not unique in the biotech land, and investors have gotten involved with several biotech companies where they want the company to liquidate and hand over the remaining cash to investors instead of continuing to burn cash. For example, Keros burned through $163 million of cash over the last 4 quarters. This is why they are using a poison pill provision to keep activist investors at bay while they figure out what to do with the company, including a potential sale.
When I heard that they were focused on pulmonary arterial hypertension, I was reminded of United Therapeutics. The CEO there, Martine Rothblatt, had started looking into and doing research on pulmonary hypertension because her daughter was suffering from that condition. And they are the leaders in that space. They also got into this big lawsuit with Liquidia, where they had a drug that United Therapeutics was disputing with them in court. And so it's interesting to see here's a third company that's focused on pulmonary hypertension and that had a failure in some sense of phase 2 trials. Moving on to updates on currently active mergers and acquisitions. President Trump directed the Committee on Foreign Investments in the United States, which is also known as CFIUS, to conduct a review of the proposed acquisition of US Steel by Nippon Steel. CFIUS is the government organization that reviews cross-border deals for national security concerns. I was looking through our database of failed deals and found a couple of examples of deals that were blocked after CFIUS review, including Lattice Semiconductor by a PE firm that had ties to China in 2017, and interestingly enough, a German chip-making equipment company called Extron in 2016. CFIUS indicated to Germany that they would block that acquisition by China's Fujian Grand Chip Investment Fund.
Getting back to US Steel, this new CFIUS review is intended to help determine whether, and I quote, further action in this matter may be appropriate. In a White House statement, President Trump gave 45 days under which the CFIUS must submit a recommendation to the president outlining whether any measures proposed by the parties are sufficient to mitigate the identified national security risks.
This is the second review by CFIUS of the same deal, which is highly unusual. I don't think I've ever seen anything like that before. The stock was up 16% in a single day following the announcement, and the spread on the deal collapsed by quite a bit because the market took this news to mean that the deal might actually close.
Meanwhile, the DOJ filed a motion to pause the lawsuit that US Steel and Nippon Steel had filed against CFIUS for 60 days until June 5th of this year. This was done in order to allow CFIUS 45 days to complete its new review, as we mentioned earlier. However, last Wednesday, Trump said that, and I quote this as well, "We love Japan, but US Steel is a very special company." So that kind of threw things for a mix. It's a little bit confusing there. He had previously mentioned that he was very open to Nippon Steel taking a minority stake in the company. So by Thursday, US Steel dropped sharply along with the rest of the market, and by Friday, the spread had once again expanded to 37%.
What an uncertain market, or what an uncertain regulatory environment for companies trying to merge. The irony in this whole thing is everybody that follows M&A expected the regulatory environment to be far more favorable under the Trump administration compared to Lina Khan's FTC and the Biden administration. Moving on, last Monday, I was invited to do a guest lecture for University of Wisconsin Business School students, and the topic I picked was the use of contingent value rights, or CVRs. As you are aware, we mostly see CVRs in biotech deals, and their payments are often tied to either new drug approval milestones or revenue milestones. So in that lecture, I mentioned a couple of unique non-biotech deals where CVRs were used. So one of them was a deal nearly a decade ago that I participated in when Albertsons, the grocery company, acquired Safeway. And there were some Mexican real estate assets that they had that they were unable to either value or sell before the deal closed. So eventually, Safeway shareholders received a CVR for the Mexican real estate assets after the deal closed. And I recollect getting paid on that CVR either a year or two after the deal closed.
Another non-biotech deal with an unusual CVR was announced earlier this year when GenDigital decided to acquire MoneyLion in a $1 billion deal. MoneyLion shareholders will get $82 per share in cash when the deal closes. Now the CVR is worth an additional $23 per share. The milestone in this case is a little bit different. It's that GenDigital stock has to trade at least $37.50 per share for 30 consecutive trading days between December 10th, 2024 and 24 months after the deal closes.
I really like the structure of the CVR because it essentially says that if this deal is good and the expected synergies are realized, it should show up in GenDigital's stock price, and hence MoneyLion shareholders are rewarded with an additional payment. Considering it's tied to the price of GenDigital stock, there is not a whole lot management can do to mess with this milestone.
When Bristol Myers Squibb acquired Celgene, there was a $9 per share CVR attached to that deal, and the payment depended on multiple drugs receiving FDA approval. Unlike most CVRs, the Celgene CVRs were tradable, and there were multiple investors and funds that started a position in them. Unfortunately, Bristol Myers Squibb claimed that due to COVID, FDA inspectors were not able to access some of their facilities, And the CVRs eventually didn't pay out, which resulted in lawsuits by funds against Bristol Myers Squibb. So hopefully we won't see the same situation play out here because, again, it's tied to the price of the stock of GenDigital.
Indeed, I remember the Celgene Bristol Myers Squibb deal quite well. Even without the CVR, the merger arbitrage situation there was very attractive, and I participated in it. And let the CVR stick around in my portfolio. And as you mentioned, it didn't get paid out. Here, in the case of MoneyLion and GenDigital, the payout entirely depends on the stock price of GenDigital, which will be determined by both GenDigital's performance over the next 2 years and market forces or sentiment. So GenDigital's stock price closed at $84.41 last Friday, implying investors are willing to pay $3.41 per share for a chance to get $23 sometime in the next 2 years. I don't know about you, but I'm kind of tempted to participate in this. Maybe on my personal portfolio instead of client side, but I'll probably take a look and see if I want to get in before this deal closes.
Yeah, CVR deals are always really, really interesting, and this one is super uniquely structured, as we've mentioned. So lots of
Indeed.
variability, but with variability comes like your high risk, high reward type situation.
Yep.
Exactly. So to wrap up our M&A section, moving away from this GenDigital deal, we'll touch briefly upon some updates regarding the Aslerin deal that we discussed back in episode 10. On March 18th, 2025, Aslerin received an unsolicited acquisition proposal from Company D, offering $2.70 per share in cash, plus a CVR of up to $3 per share based on regulatory approval and global sales milestones for one of Aslerin's drugs to treat thyroid eye disease.
Acelerin, which is currently in a deal with Alumis, promptly notified Alumis of the offer. The following day, the Acelerin board met to discuss the proposal and instructed CEO Mina Kim to reach out to Company D for clarification. After further review, the Acelerin board determined that Company D's offer could reasonably be expected to result in a superior proposal, which would mean normally that they would walk away from the Alumis deal and pay the termination fee. Acelerin notified Alumis of its intention to engage with Company D and provided Company D a draft confidentiality agreement.
Now, in a shocking turn of events, Company D informed Acelerin that it would no longer pursue the acquisition, and Acelerin notified Alumis in writing that discussions with Company D had ended. So that was super strange to see. A new company, an undisclosed company, came in, offered a higher offer. Acelerin began talks, and all of a sudden that deal was revoked, so Acelerin happily went back to Loomis and said, okay, we're back to this deal now.
Mind you, this isn't the only superior offer that Acelerin has received. When we talked about the deal in episode 10, we mentioned that Concentra Biosciences had come in with a $3 per share bid, which Acelerin didn't engage with. So the whole thing is fascinating. I love it when there are competing offers after a deal is announced. So it creates a bidding of a war, if you will, and often you end up with a very high price. But in this case, unfortunately, that was not what happened in the end.
Moving on, the spin-off realm was pretty quiet this week, but the one spin-off that we wanted to feature was the Germany-based automotive supplier and tire manufacturer Continental, which announced plans to turn its ContiTech rubber and plastics division into an independent entity, setting the company up to be a pure-play tire maker after the planned spin-off of its automotive segment. The separation is to be implemented after the spin-off of its automotive unit, which a supervisory board formally approved last month and is due to take place this year.
I've been following its competitor Goodyear for several years, and it hasn't done very well. So it's surprising to see that Continental wants to become a pure play tire company, especially in this environment with tariffs and input costs going up.
Right. It's also been super interesting to see all these massive conglomerates splitting their businesses up. We've seen it with GE, we're soon to see it with Honeywell, and now Continental as well. Though the various businesses that are being split up for Continental are a little bit more intertwined than something like GE Healthcare and GE Vernova, which is their energy business. And that reason might actually be why labor representatives have called the spin-off, the Continental spin-off rather, socially irresponsible economically reckless, and technologically nonsensical, which are some pretty big words and pretty big claims to have made.
I'm surprised they're saying that because often spin-offs do unlock a lot of value. And it makes sense for companies to spin off businesses that don't really align with each other. We have to take a deeper dive into Continental to understand how these three businesses work with each other. But in the case of Honeywell, the spin-offs make a lot of sense. And I think that'll be value created there.
Buybacks were similarly not all that exciting or massive this week. The semiconductor company Broadcom, for example, announced a $10 billion buyback, but it only represents about 1% of the company's market cap. The buyback announcement also appears to be mostly in response to the continued share dilution we've seen at Broadcom, which can partially be attributed to the large share-based compensation we've been seeing at the company.
Yeah, we've been keeping an eye on Broadcom since it's a key competitor to another smaller technology company we've been actively invested in the model portfolio called Marvell Technology. That being said, Broadcom is massive compared to Marvell, and the company's fared very well over the last 5 years, up about 117%. The company is run by Hock Tan, whose strong leadership has steered the company well, and Hock Tan also joined Meta's board of directors.
Another buyback we quickly wanted to cover was at ArcelorMittal, a Luxembourg-based steel manufacturing corporation. The company announced a $200 million buyback that still only represents about 1.3% of their market cap. ArcelorMittal has steadily been repurchasing shares over the last few years, buying back over 30% of all shares outstanding over the last 3 years. The company might appear familiar to some merger arb investors, as back in August 2023, it was potentially interested in acquiring US Steel, but as we all know now, that didn't quite play out.
Yeah, I've looked at ArcelorMittal in the past, as well as US Steel and Cleveland Cliffs. It's actually a very well managed company. And it's likely that they would have run into the same issues that Nippon Steel is running into now to try to close a US Steel acquisition. We'll wrap up our buyback section with a buyback announcement at Argon, which is a company that provides engineering, construction, and consulting services to the power generation industry. Argon scores a perfect 100 on our IA model, which is a quantitative model that we built that looks at, I think, as many as 14 different factors spanning business conditions, momentum, valuation, so on and so forth. And the company has performed very well over the last year, with the stock up 146%. Financials are similarly impressive, with strong top and bottom line growth, a balance sheet with cash, and fairly decent free cash flow. The company has bought back stock before, but this most recent buyback is quite tiny, just $25 million, representing a little over 1% of the company's market cap. The only reason we are actually talking about this company is because of its perfect 100 score on the IE model.
Right. During this buyback section, we typically talk about companies with some really large buybacks, 26%, 30%, so on and so forth. But it was interesting that this week we really only covered companies which had buybacks representing around 1% of their market cap. So that was odd to see. It's pretty unusual. But I think each of these companies had some interesting bit to them aside from the buyback, which is why we decided to note them down and talk about them in the podcast.
Yeah, and as companies announce earnings in the next few days and weeks, we'll see some interesting buyback announcements come out of that as well. Switching gears to insiders, insider buying picked up significant steam, with insiders buying over $140 million worth of stock, and selling declined sharply to just $516 million. It was $900 million of sales the prior week. If we had been outside earnings related quiet periods, I think we would have seen even more insider buying, and maybe we would have experienced what we saw in March 2020, when during COVID, insider buying for the first time in over a decade surpassed insider selling. Usually, insider selling is 20 to 30 times the amount of buying. So, for example, if it's $100 million of buying in a given week, you'll see $2 billion or $3 billion worth of sales. Last week, the selling was just less than 4 times the level of insider buying. So quite a bit of confidence from insiders, and it'll be interesting to see how this plays out.
Yeah, that ratio of insider buying and insider selling is always an excellent signal to pay attention to because individual insider buys and sales can often be ill timed or wrong, but insider buying and selling in aggregate often implies that there's something deeper worth diving into. But getting to those specific insider purchases, we actually saw the executive chairman of Sinclair, a TV broadcasting company like Tecna that we've actually talked about in prior episodes, pick up an additional $6.2 million of worth of stock.
Yeah, we mentioned his insider buying a couple of weeks ago, and he was willing to pay as much as $17 for the stock. Given the recent turmoil in the markets, the stock is now trading at $13 and change. So, TV broadcasting companies are cyclical businesses, and their fortunes are tied closely to election cycles. They do very well during presidential election cycles and during the midterm elections, as political advertising on TV increases quite significantly. In fact, I recently sold shares of Tegna after the tailwind from presidential elections subsided.
Beyond broadcasting, Sinclair also owns a surprisingly large variety of businesses, including TennisChannel.com. The company has also invested in a pickleball business and has a bunch of investments in VC firms, PE firms, and real estate. So, very odd sort of range of companies there. But broadcasting seems to be the primary business. So, going back to that point about cyclical broadcasting companies, that brings up an interesting question of why is it that the chairman, who has been involved with the company for nearly 4 decades, buying shares now? It could just be that he's seeing broadcasting companies be able to increase their market share through acquisitions during this new current administration, but it might be something else entirely.
Yeah, the other interesting insider purchase we saw this week was three different insiders of the meme stock GameStop pick up shares. CEO and Chairman Ryan Cohen bought 500,000 shares worth almost $11 million, and two directors picked up 5,000 and 10,000 shares each. We have seen these directors purchase shares before, and their connection to Ryan Cohen stems from their Chewy days, where they used to work in the management team at Chewy. As you know, Ryan Cohen made his money by selling Chewy to PetSmart in 2017 for $3.35 billion.
Yeah, even as the entire market was pretty much suffering due to the tariffs, GameStop was one of the few companies that actually rose. I think that just goes to show that the company's really never going to lose its meme stock status. It doesn't react or act in the typical ways of any stock of a normal company. So it was interesting to
Yeah,
see them purchase shares now.
as you know, they actually benefit from console cycles. So when new consoles are released, they benefit from sales of the consoles and new games that come with the new console. Nintendo, which was going to release the Switch 2, actually pushed out the release date by several months after the tariff announcements. So maybe they were, expecting improved sales. Maybe it is because, as a friend was saying, they have a lot of cash on the balance sheet. I haven't quite verified that, or if they have any Bitcoin on the balance sheet. So clearly something is going on there.
Yeah, actually, speaking of that Nintendo 2, the Nintendo 2 was already expected to have an incredibly high sticker price.
Yes.
And with this new tariff announcement, God knows how much more expensive it could get and how that might impact consumer demand.
Yeah, the price of the Switch 2 is getting close to where the Xbox and the PlayStation are, which is why people are surprised whether Nintendo can compete at that price point.
I will say, though, we have gotten plenty of use out of our Switch personally, and I look forward to that whenever I get home.
Yeah, Mario Kart seems to be a game of choice.
Right. But going back to this actual podcast, we're not going to dive into these following companies as deeply, but we still wanted to mention that, as per usual, we saw Dustin Moskovitz buy $6.72 million worth of Asana shares, and that we also saw the CEO of the LPG shipping company, Dorian LPG, purchase 30,000 shares for a little over $500,000. Dorian was a company we were tracking, what was it, like a year ago? A little over that. And it did well for quite some time. And then in the last year or so, the stock price is down quite terribly.
Yeah, I sold some covered calls on my Dorian position to pick up some premium. And then I've been collecting the $1 a share quarterly dividend. But despite all of that, my position is underwater at this point. which seems apt considering this is a shipping company and should be above water, but it is underwater for now.
I did not do any of that, simply got a position in Dorian, and that is all the more underwater right now. So, not a very happy Dorian investor at this point in time, but hopefully it turns around in the long term. Okay, so moving on, we might sound like a bit of a broken record here, but the activist space was also unusually quiet this week. We did find it quite amusing to see that Elliott launched a podcast about Phillips 66, which is focused on interviewing each of their new director nominations for the company's board. And in the same way that we love to discuss Elliott on this podcast, Elliott seems to love launching podcasts to interview director nominees for whatever company they're actively trying to disrupt the board of. They actually did the same for Southwest Airlines last year with their Stronger Southwest podcast.
That is fascinating that they launch a new podcast related to a company that they're going activist on. That's fascinating. The other interesting bit of activist activity builds off of things we discussed in episode 4 and episode 10. The activist Ancora, which has been involved in US Steel for quite some time, was actively opposed to the US Steel and Nippon Steel deal, wanted a new CEO for the company, and was hoping for a turnaround. Actually withdrew its nomination for US Steel's board due to apparent momentum surrounding the proposed $55 per share sale to Nippon Steel. So it's actually fascinating when you think about it. Midweek, everybody felt like this deal was going to go through. And then towards the end of the week, people thought that US Steel, Nippon Steel deal might not go through. But looks like Ancora interpreted it the same way as the market earlier in the week, that it's higher probability that this deal will actually close.
Last but not least, we'll transition over to C-suite transitions to wrap up our episode as a whole. There were actually a number of interesting C-suite transitions, but we'll talk about 3 of the most interesting ones today. CVS's CFO and Chief Medical Officer both resigned from their positions, with the current CFO set to become a strategic advisor to the CEO. The new Chief Medical Officer, Amy Compton Phillips, comes over from the private company Press Ganey, which is a healthcare company known for developing and distributing patient satisfaction surveys, and has the most widely used outpatient satisfaction survey used in the United States.
Yes, when I saw that the CMO was coming over from Press Ganey, I was quite surprised. I used to, as you know, work for a healthcare company. And when we were going to do our NPS surveys, we considered looking at or using a company like Press Ganey. So from a company that does medical surveys to CVS is quite the jump. Meanwhile, the new CFO, Brian Newman, comes over from a relatively unrelated company, UPS or United Postal Service. This C-suite transition news also comes a couple of months after CVS announced a potential breakup of the company to separate its retail and insurance units amid pressure from investors. The company certainly has a growing debt balance, and as we see with most spinoffs, the parent company is able to offload a lot of debt onto the business that is being separated.
I will say, as we were discussing the CVS C-suite transitions while prepping for this podcast, we were reminded a lot of Walgreens, which we talked about back in episode 9. Walgreens is getting acquired by the PE firm Sycamore Partners in a fascinating and complex deal that involves potential divested asset proceed rights, or DAP rights, connected to Village MD, which in some sense was Walgreens' response to CVS's Minute clinics. After the Walgreens acquisition, CVS will become one of the only large publicly traded pharmacy chains.
This potential separation that they might have is going to be interesting because CVS's front of the pharmacy operations are going to be impacted by tariffs, while the back of the pharmacy operations as well as their insurance divisions are going to benefit from increased reimbursement rates from Medicare that helped the entire insurance industry last week. Another interesting C-suite transition we came across was Madison Square Garden Entertainment announcing a new CFO. The previous CFO had left back in November of last year, and the company's SVP of Financial Operations has stepped in as an interim CFO for a period of time. Madison Square Garden Entertainment has always been a company we've kept an eye out on since it was spun out of Sphere Entertainment, which controls a fascinating event venue also known as the Sphere in Las Vegas.
The details of the spin-off are a little odd. Sphere was originally named Madison Square Garden Entertainment, but then that Madison Square Garden business, which produces and hosts various live entertainment events, including concerts and sporting events like professional boxing, college basketball and hockey, and more. So that whole Madison Square Garden business was spun out of the original company, leaving only the Sphere business division.
I know when we looked at the Sphere spinoff, you and I had differing opinions. You were quite bullish on Sphere, and I wasn't. I still love what they've done in Vegas, and if they end up doing a second Sphere in the Middle East or a third one, I will certainly revisit the company. We'll wrap up a C-suite section with everyone's favorite motorcycle company, Harley-Davidson. The company has not fared very well recently, down 43% just in the last year, which may have contributed to why the CEO announced his retirement and planned to leave the company. We also saw board member Jared Duderville resign from Harley-Davidson this week, and he actually issued a letter to the board openly criticizing the company's severe underperformance, the revolving door of senior leadership, the lack of board oversight, the overall absence of a winning culture at the company, and accountability and transparency issues with the company at large. He seemed to really have an issue with the fact that the management team and most of the white collar part of Harley Davidson was working remotely instead of from a central headquarters, if you will.
Yeah, it's a fascinating letter that I recommend everyone read if they get the chance just to see it in his own words. Harley Davidson also had a very interesting spin-off in September 2022, where they spun out Livewire Group into a SPAC to form a publicly traded company. This type of spin-off where you separate a business division and then you merge it into another company and then form a public company out of it is called a reverse Morris Trust transaction and is pretty rare to see. The Livewire Group produces electric motorcycles, and understandably, the business hasn't fared too well. The stock trades at $2.36 compared to the pre-SPAC business combination price of $10 per share, and the company remains unprofitable.
Yeah, I had looked up Livewire around the time the spin-off was announced, and I didn't find the motorcycles particularly attractive. And the price point, I think they start like $15,000, seemed even less attractive considering how the motorcycles looked, the electric range they had. And sure, you get from 0 to 60 in 3 seconds on the motorcycles, but you could do that with many Teslas and as well as with the Lucid. And so you don't have the same exhilarating experience you got on motorcycles before.
Yeah, I think the idea is just that the target market that motorcycles address or motorcycles are made for aren't really buying electric motorcycles. They're going for your classic ones instead, which is likely
Different,
why the Livewire Group is suffering.
yeah, definitely not the high-end one that costs $15,000 and upwards.
And that wraps up episode 14 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool. Check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who might be interested in special situations. Thank you.